I may have outdone myself yet again. Another gem that gets absolutely no love in our investing community. It's going to get plenty of love once I expose it for the dividend cash cow that this company has become and the great capital appreciation it has also provided in its history. The company I'm talking about is Hercules Capital. It is a financial helper for companies that are just starting out and rapidly growing. Hercules is a business development company, which means they help smaller companies with funding to help grow their business. They help them buy equipment, they're helping them develop new products with loans or equity investments. They collect interest on this debt, which goes toward their total net investment income received. Now, just like you don't have 100% of your portfolio in one position, well, maybe I'll take that back. I know some of you are YOLOing it all on Tesla or the new dumb channel that has come out and putting it all in on AMZY. Neither does Hercules. Instead, they spread the risk around by investing in many different companies to get a very diverse portfolio. Sure, there's going to be some companies that fail, but the successful companies generally outweigh the failures. They currently have an equity stake in 74 different companies and warrant holdings in 103 different companies. A warrant is sort of like a special coupon that allows one to buy into a company at a specific price, just like a coupon, and just like a coupon, they're not obligated to use it. Hercules specializes in investing in pre-IPO and M&A companies that are in the established stages of technology, life sciences. They also have a major focus in healthcare and small pharma, and they also have sustainable and renewable industries that they're invested in. They call this their investment and expansion of venture growth, and they currently have $3.4 billion in total assets. Now, one big advantage of Hercules Capital is that they are an internally managed BDCs. Most BDCs are externally managed, meaning they pay an investment manager fee to a special advisor, which could be a couple percentage points, and that really eats away at the BDC's total returns. This allows Hercules to maximize investment returns, and by being a business development company, they also get special tax benefits. Similar to REITs, if they distribute by law 90% of their taxable income out to shareholders in the form of dividends, they get a special pass-through provision like not having to pay corporate income tax at the company level. This is why BDCs like Hercules pay huge dividends. Hercules has a fantastic starting yield of 8.3%. Yeah, this time I can just take what Seeking Alpha tells me, no chance at me miscalculating it yet again. Just some more fun facts about Hercules Capital so you can get a more holistic view of this company. So they have over 110 full-time employees in 8 states and 2 different countries. In 2023, the average deal size was about $46 million, and 2023 deal size ranged from $3.7 million all the way up to $150 million. They have 75 consecutive quarters of paying dividends, and they've paid out almost $2 billion in dividends since their IPO in 2005. And they've done more than $20 billion in total gross debt commitments since October 2024. Now, this is where Hercules really flexes their muscles. They IPO'd in 2005, and ever since then, they have paid a regular quarterly dividend, including during the 2008-2009 financial crisis, and as well as the 2020 forced shutdown crisis. Throughout all these global problems, they were still being a profitable company and rewarding shareholders with quarterly dividend payments. Now, if those juicy dividend payments weren't enough, they've also been giving out that special steroid diet and paying out special supplemental dividends. This is often just a few pennies, but imagine having hundreds of shares of Hercules. That could really start to add up. And there's also been quite a few of these in recent years. So for the first 17 or so years of this company going public, it really didn't change much in share price. It was just paying out dividends and the share price remained flat. But after C19, that really changed. The share price started going up and up and up. And in the past year, this company has absolutely went to the moon. They're up 53%. This is in 1 year. That is 2 times the return of the S&P 500 in the same time span, which is up just about 20%. I put just in quotes there. Now, Hercules may be a mythological person, but Hercules the company is not a magic beans investment. As with anything in life, it's not all positive. Because of Hercules' rapid run-up, the BDC is now trading at a 1.67x current price to NAV valuation, which means it's trading at a lofty, potentially 67% premium, which indicates investors are willing to pay quite a lot of money for shares of Hercules. Now, this could actually be justified, as their net investment income just keeps going up and up every single year. They've had a 15.3% CAGR since 2013. So in the past 10 years, this company has absolutely exploded in total growth.
I just exploded.
This is across so many different segments. Their total assets has also went up 11% CAGR every single year. Total investment at cost up 14% CAGR. To see all these have double-digit growth rates in the same time span, these are all big green flags. That's something I love to see as an investor. Now, lower interest rates could also have mixed effects on BDCs, as this could potentially lower the cost of capital, increase portfolio valuations, and NAV. But since BDCs typically invest in high-yield debt, when interest rates are low, the yield spread between riskier investments and debt and safer assets may narrow, and that might reduce the BDC's income earned from their investments. Now, Hercules does have some protection, as 96% of their loans are floating rate loans, which means there is a limit in place on how low these rates can go, giving some downside protection with interest rate cuts. Hercules has obviously operated in a low interest environment before and absolutely thrived. So it's very possible they're going to be able to continue to thrive whenever and if ever the Fed ever cuts interest rates. Because let's face it, the chances of the government being able to cool off inflation these days, that's starting to sound like mythology as well. As you guys know, I'm a partner of Seeking Alpha, and let's talk about some of these amazing ratings and analyst recommendations. They have buy ratings across the board, including a strong buy here. When we look at their grades, we see valuation is an A-, growth is an A+, profitability A+, momentum A-, revisions B+. It's actually very rare for me to ever see a company do this well across the board, get all the good ratings. Different people keep writing about this company. Buy rating, buy rating, buy rating, hold, strong buy. So definitely a company to keep on your radar. This is not the first time I've mentioned Hercules Capital on this channel, but BDCs, they still seem to be one of the most overlooked aspects of the stock market. Now, one company known worldwide is JP Morgan Chase. But find out right here about the grim warning their CEO, Jamie Dimon, gave about the economy. Remember to leave a like and a comment for a small-time YouTuber. My videos are always found in podcast form under the Collect Cash podcast name. Let me know what you think about Hercules Capital in the comments below, and I will catch you on the next one.